As tax strategists, we took a California couple from the highest tax bracket to a 0% tax bracket in 5 years. How? Performing what I call a strategic rollout, not a rollover. This is a rollout of their IRAs and 401ks. Get ready. In this episode, I'm going to explain how we did this with a strategic rollout. And in 5 years, they were enjoying $600,000 to $800,000 a year of totally tax-free income for the rest of their life. So I'm Doug Andrew. I've been a financial strategist, a tax specialist, okay? Helping people prepare for a comfortable retirement now for north of 5 decades. Years ago, I developed what I call a strategic rollout strategy because I realized that most Americans are duped into putting money into tax-deferred IRAs and 401ks, being told, keep deferring, postponing, procrastinating in those accounts because you'll likely be in a lower tax bracket when you retire. Well, the people that I worked with were savers, and they were not in lower tax brackets. Most of them were in as high or higher tax brackets during their golden years as they ever were in during their earning years. Now, why is that? It's because a lot of times as we go through life saving for the future, if we put money in tax-deferred accounts, getting a tax break on the contributions, okay? If you were a farmer and you had the choice of buying your seed in the springtime, and you don't have to pay tax on the price of the seed, but you plant that seed and you irrigate, you cultivate, and you work hard, and then later on in the fall when you harvest your crops, now you agree to pay tax on what you sell your harvest for. That's a traditional IRA or 401k. You get a tax break on the seed money, the contributions. You put in tax-deductible dollars into an IRA or pre-tax dollars into a 401k, and then it grows tax-deferred. But later on during the harvest years of your life, now you're going to pay tax. And actually, it's pretty brilliant for the government because it's the best savings bond the government ever came up with for themselves, because they have a permanent tax lien on everything you accumulate in a tax-deferred IRA, 401k, 403b, 457. I don't care what kind of a qualified plan you're talking about. They get to reap the benefits. They're your partner. They get to call the shots, and they will reap all of the growth that you achieved. They get a piece of that the rest of your life, okay? So I saw the writing on the wall years ago that successful savers are usually not in lower tax brackets because a lot of people, they go through life and they're putting money in tax-deferred accounts like IRAs and 401ks, and simultaneously they're paying off their real estate mortgages, let's say, okay, killing their deductions. This is like going down the highway with one foot on the gas pedal, deferring money in IRA to 401ks, but the other foot's on the brake pedal, and you are killing your deductions. Later on in life, you are not contributing money to IRAs or 401ks, so you lose those deductions. The kids are gone. Or if they move back in as adults, you can't deduct them anymore as dependents, okay? Many of my clients were business owners, and if they sold their businesses, they don't have those deductions anymore. And because of irresponsible government spending and the printing of money, most people agree that taxes in the future will likely be higher. So why do we continue to postpone and defer, procrastinate paying tax on these to some future perceived unknown advantage and then withdraw our money later when we're convinced taxes will be higher? That doesn't make sense. And even Congress realized that a lot of smart people did not want to do that. And so that's why when the government was hard up for tax revenue, they decided rather than waiting until retired couples, started taking money out of these and they got tax revenue. Because I don't know if you realize this, but the government plans their budgets oftentimes on how much money they're going to get in tax revenue from how many retired people are forced to take RMDs, take money out of their IRAs or 401ks. They plan the federal budget. That's a big part of their budget. And so the government was hard up for money in 1997. Senator Roth said, hey, I have an idea. Smart, savvy people, they realize they're not going to be in a lower tax bracket. So let's let them roll over to a Roth. We'll call this, a Roth IRA, and then later a Roth 401k. And so they got the taxes over and done with sooner than later at today's lower rates. And then it accumulates tax-free, and they can enjoy tax-free income. It was a step in the right direction. There's still a lot of strings attached with Roths. You can only put in a certain dollar amount or a certain percent of your income, and you can't touch the money for 5 years or till you're 59 and a half and so forth. I've never owned an IRA or 401k, nor a Roth IRA or 401k, because I don't want to have all those strings attached, those different rules. I would rather accumulate my money totally tax-free, like a Roth, and be able to access that money totally tax-free and not be limited to what I can put into it, be able to tap into it even 90 days after I deposit money into it if I want without any penalties, and be able to participate when the economy is doing well, but not lose money when the economy crashes, and that's called indexing. So IUL is sometimes referred to as the rich person's Roth. You don't have to be rich to have an IUL. You can set one up for $500 a month. But when you set up an IUL, it accumulates your money tax-free. You can access that money anytime without triggering tax. And then when you ultimately die, it blossoms and transfers tax-free if you structure the IUL correctly, okay? Now, that's why we teach this to financial advisors. Well, years ago, when people would come to me, they would realize that they're not going to be in a lower tax bracket, so they wanted to get the taxes over and done with sooner than later. So I designed what was called a strategic rollout, not a rollover. A rollover is going from the frying pan into the fire. This is where people get duped into taking their money in 401ks and then rolling them over to IRAs. And then postponing till age, it used to be age 70 and a half, now it's age 72, 73, and then taking RMDs, required minimum distributions, thinking you're saving tax. You're not saving tax, you're actually compounding it. If you calculate the amount of tax you will pay, when you start taking those RMDs throughout your life expectancy, your spouse's life expectancy, and then as it transfers down to your children, your heirs, they have to pay tax on that within 10 years. People are flabbergasted when they see the amount of total tax that you pay. So deferring is very myopic. You're not saving tax. You might be paying some tax on that in a given year. But over the long haul, the big picture, you're not saving tax. You're increasing your tax. And so I teach this in advanced continuing education to CPAs and tax attorneys. So one of the first steps in a strategic rollout is you want to get the money out strategically so that people are not forced into a higher tax bracket, but take advantage of the room in their current tax bracket before they go to the next threshold. And sometimes there's quite a bit of room where you could withdraw 30, 40, 50, 60, 100,000, even 150,000 a year without paying any more than 22% or 24% in that tax bracket as of the recording of this episode, which is in the year 2025, okay? And then you reposition the after-tax money into something that's going to be tax-free from now on, which is max-funded IUL. And then ultimately, at the end of the day, when you pass away, your spouse, your family gets reimbursed any of the tax you did incur during the rollout because the money in the IUL blossoms and transfers income tax-free. So you're not out anything at the end of the day if you do it right. Now, there's a third part of the strategy that sometimes I help wealthy people resurrect deductions that they'd been killing by paying off their rental properties or whatever. We refinance those and we resurrect tax deductions, and that offsets the tax. So I've helped many, many people save $250,000, $750,000, $1.2 million of unnecessary tax doing strategic rollouts. Well, this episode is about a California couple. California has one of the highest state income taxes on top of federal. And this couple was in an effective tax bracket at basically 1/3, 33%. And they knew that they were never going to be in a lower tax bracket. I mean, they saw the writing on the wall. So rather than buying into defer, they came to one of our educational seminars. We got together with their tax planner and tax attorney, and they agreed finally. Oh, yeah, they're not saving any money. Let's just bite the bullet, get the taxes over and done with, because their current tax bracket was likely the lowest bracket they would ever be in. Okay. And so they had $6 million, $6 million accumulated between the husband and wife in their 401ks and tax deferred accounts. What we did is we strategically rolled that out, that $6 million, over a 5-year period, okay? And so when you do the math, you're pulling out a pretty big chunk of money every single year, but they weren't going to be in a lower bracket anyway. It's like, well, didn't you send them into a higher bracket? No, they were already in the highest bracket. So we got $6 million out of their IRAs and 401ks over a 5-year period. Now, why did we wait over 5 years? Because you have to fund an IUL policy over a 4 or 5 year period in order for you to be grandfathered to access your money tax-free under the TAMRA tax citation and avoid what is called a MEC, a modified endowment contract. And so that's what we did. So long story short, they ended up with $4 million after paying $2 million in tax. But they were going to pay the $2 million sooner or later. In fact, it was going to be more than that if they kept deferring. So they got their taxes over and done with, $2 million. We netted $4 million into their IUL policies. So that was about $800,000 a year that went into their IUL policy. So at the end of 5 years, they now have $4 million in 4 IUL policies. Okay. That $4 million, they were still earning money, so they didn't retire. And they let it grow, and they earned an average rate of return of over 9.6% net, okay, because we know how to diversify with the various indexing strategies and rebalance. And so if you watch other episodes on this channel, you'll understand how we are able to move rates of return that are generally 7 to 10% up to 11 to 14%. So very conservatively, they were earning, like 10.6, netting 9.6. Now you divide 9.6%, that's net cash on cash, into the rule of 72, and their money will double in 7.5 years. So 7.5 years, 4 million doubled to 8 million. Okay. Then they were prepared to retire. Now, we've done this many, many times. So here we have this couple now with $8 million totally tax-free. That $8 million is generating, again, 9 to 10% rates of return. Now, $8 million, they could take out $800,000 a year if that's what they're earning, totally tax-free. There's nowhere to put it on a tax return. The IRS knows they received that $800,000, but there's no need to audit it because money out of a permanent life insurance policy has been tax-free for over a century in the Internal Revenue Code. It's not even worth auditing. They don't even need that much money. They only need $300,000 a year because they pull out $300,000, they net $300,000. In their tax bracket, they would have had to have pulled out $450,000 out of an IRA or 401k to net $300,000. Okay, and because of a 33% tax bracket, and so they only have to pull out $300,000. So their IULs are actually growing at least $500,000 a year, in spite of them pulling out $300,000 tax free. They are in a 0% tax bracket. To be honest with you, we recommend most people, our retirees, should have 40 to 60% of their retirement income not show up on the front page of their 1040 tax return. This couple, they said, we want 100%. And we go, okay. And so they are in a 0% tax bracket. If they didn't have any other income like Social Security or anything like that, they wouldn't even be required to file a tax return. Because if you have no taxable income, there's no reason to file a tax return. Or if you have no income that is deemed earned passive or portfolio income, you have nothing to report. And that's the money that comes out of max funded indexed universal life. So the message here is, if you have money trapped in an IRA, 401k, pension, profit sharing plan, or whatever, and you realize you're not going to be in a lower tax bracket, you ought to explore a strategic rollout. You ought to talk to one of our IUL professionals, and here's how you can do that if you're interested. You can read the stories like this in our most recent best-selling book, The Laser Fund. Now, this book has been flying off of our warehouse shelves. We are in the 4th edition of this, and it's actually 2 books in one. This side, the white side, is the left brain side, which has all the charts and graphs and explanations. If you like to learn with numbers. If you learn more by stories like the one I just told you, you just cut to the chase, you turn it over to this side. And this is about 100 pages, 12 chapters with 62 actual client stories. And there are stories, there's a whole chapter dedicated to strategic rollouts that includes stories like this one. If you want to use your whole brain, your right brain or your left brain, you can read the entire book. Now, it retails on Amazon for $20 up to $60. If you bought it on Amazon, thank you, but I'll give you a copy for free. You simply go to laserfund.com, L-A-S-E-R fund. That stands for Liquid Assets Safely Earning Returns. And a laser fund is a properly structured max funded IUL. You go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little skin in the game, but I will pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can schedule to attend one of our educational webinars that we teach every week. No cost, no obligation. But there is an opportunity to schedule an appointment, if you would like, with a trained IUL professional that I oversee, that I've trained, and they can create illustrations of how a strategic rollout may work in your particular set of circumstances and get the taxes over and done with sooner than later. If this couple that I've been talking about had continued to postpone and defer and taken RMDs, they would have probably paid close to $4 million in tax. So we, in essence, saved them $2 million in tax by doing a strategic rollout, and we dramatically increased their income over what a 4% payout would have been on their IRAs and 401ks. So this is not about us. This is about you and your brighter future. Take affirmative, proactive action and save a bunch of money in unnecessary tax today.